Hello, and welcome to this week's market update.
Latest news.
We're going to start off with some positive news, as progress is being made regarding the Israel and Hamas ceasefire. Monday morning saw hostages being released on both sides, raising hopes of lasting peace. Trump even told reporters that the war was over, despite the fact that there are still many questions left unanswered regarding the second phase of the deal, which involves Israeli withdrawal from Gaza as well as Hamas disarmament, which might prove not as straightforward. Moreover, decisions on the future governance of Gaza, as well as any reconstruction plans, seem to be even more challenging. Prices continue to ease on the back of this news, where if progress continues to be made, a significant reduction of geopolitical risk premium, especially in oil markets, can be expected. Important to note that this breakthrough could have wide-ranging implications, including the possibility of decreased attacks in the Red Sea and a potential renewal of negotiations with Iran regarding its nuclear program, as well as oil exports. Now turning to Europe, where the French political crisis continues. Sébastien Lecornu was reappointed as French Prime Minister only within a few hours of his resignation. The main task continues to be the budget approval for 2026. However, there's little room for hope, as a no-confidence vote is highly expected, given the fact that the same government did not receive the needed support from the parliament only a few days ago. On the right, you can see the current French parliament distribution, where President Macron's party, in purple, will have to form alliances with other heavyweights to achieve the 50% majority required. Depicted in dark blue is the far-right party, while the main leftist groups are shown in red and pink, both of which have shown deep disagreement with each other. The market impact is being felt primarily on the French equity and bond markets, but given the specific weight that France has on the whole European Union, uncertainty could spill over the whole bloc if the situation continues. A short-lived price spike was triggered by renewed threats of 100% tariffs on Chinese goods made last week by President Trump. The threat came after China announced increased controls on rare earth exports, which was in turn caused by a similar measure from the US regarding chip-making equipment exports. Trump backtracked on Sunday, only 2 days later, as he signaled openness to reach an agreement with China, calming rising tensions. The initial impact on the markets was a sharp drop in oil and equity prices on Friday, while prices more moderately rebounded on Monday. Despite the swift nature of this price movement, it must be remembered that geopolitical factors are still very much at play and can change the situation rather quickly.
Weather.
We are seeing mild temperatures across most of Europe, with the notable exception of Spain, where temperatures 7 degrees above the average are expected in coming days. Precipitation is set to increase these next few days and will intensify in the beginning of next week, particularly in the Mediterranean Sea. The hurricane season continues, with Tropical Storm Lorenzo now present in the Atlantic, although it is still quite far from any potential harm on the US export infrastructure.
Macroeconomics.
The only new data point that we have is inflation for India, where an 8-year low was reached in September for a 1.5% inflation year over year. This increases the chance of interest rate cuts in India, where the reference rate sits currently at 5.5%, fueling even further optimism in India, which is by far the outperforming in economic terms globally.
Crude oil and LPG.
Neutral to bearish evolution, mainly on the back of the ceasefire news, as the escalation of hostilities and threat of attacks from Iranian proxies are now less likely. Markets continue their downtrend as looming global oversupply is being met by signs of economic slowdown, which, by the way, is being worsened by the US government shutdown, resulting on less economic data available. Some factors preventing a steeper increase in oil prices include the geopolitical risk premium from Russia and Ukraine conflict, as well as the OPEC Plus recent announcement of an output hike that was less than what the market was expecting. Also, China seemed to have been gradually restocking at lower and lower prices, but it remains to be seen if they will continue with this strategy as more crude is being pumped into the market.
Natural gas.
Gas prices this past week were practically unchanged. But if we zoom out a bit, we're seeing the Cal 26 dropping by around 7% over the last 3 months, where similar moves in the quarterly products are being seen. Mixed fundamentals and economic uncertainty are keeping prices steady. Price stability is usually a sign of a balanced market, although the fragility of it at this stage is quite relevant given the storage situation, which is now struggling to improve, which is probably the main reason partially preventing even lower prices. Current stock storage levels, as you can see, hover around the 83% mark, while injection rates continue to decline. The deficit versus a year ago has remained steady for the second week in a row, which is particularly worrisome given Ukraine's storage infrastructure being almost completely depleted and physically at risk. They even recently announced their intention to increase imports by 30%, prioritizing volumes for October through December ahead of winter. In that sense, recent uptick in European gas demand has been linked primarily to weather-related demand spikes, while total supply remains closer to the end of the 5-year range. These bullish factors are being offset by increased European LNG imports, with 2025 volumes being more than 20% higher than those of the last 5 years average. Also, maintenance season in Norwegian infrastructure is almost over, with fewer unplanned outages than last year, resulting in healthier flows throughout summer. Lower competition between Europe and China for LNG cargoes out of the US is being clearly reflected on pricing, as well as well-supplied Chinese market, which continues to import from Russian Arctic LNG to sites, further reducing competition with Europe. Finally, looking at investment funds positions for TTF, where clearly the speculative players are no longer expecting higher gas prices. Not only that, but the net length is close to turning, potentially sending investment funds sentiment into bearish territory.
Coal.
Coal is showing more of a bearish picture, with a drop of around 3.2% in IP2 Cal 26 last week, but also AP4 and Newcastle prices dropping along the curve. On the bullish side, it seems like further downside is quite limited as prices now near production cost margins, which could potentially then trigger some supply cuts by producers. We have as an example Colombian producer Cerrejón, who announced earlier this year that they would reduce annual production from 15 to 10 million tons per year because of low demand. Similar situation is being observed in China, where coal imports dropped 12% year-over-year in the period between January through August, showing signs of very weak demand. This, together with the abundant supply worldwide, is pushing prices down. Increased renewables capacity being installed comes very often at the expense of coal production and coal-fired generation. And furthermore, rising EUA prices are deteriorating the clean dark spreads, promoting coal to gas switching.
EU and UK emission allowances.
Carbon is behaving differently, as we see more of a bullish momentum in both UK and EU allowances, although moves this past week were limited and even seeing some profit taking in the UKAs following a strong rally. The expected tighter market as of 2026 and the prospect of linkage between UK and continental Europe ETS are the two main drivers supporting prices. Structural factors that appear to be tightening the market include accelerated emission cap reductions, increased compliance obligation, and the progressive phase-out of free allowances, among others. Helping the rally is the boost in power sector emissions, as you can see on the right-hand side, where emissions have been higher than 2024, primarily due to weather-related demand coinciding with periods of low renewables. Looking at investment funds positions, their net longs continue to hover near record highs in both markets, further fueling the rally, although good renewable generation is expected in the next few days, which can keep a lid on prices.
Electricity.
In electricity prices, we are seeing a bit of a bullish run, especially compared to those of gas, where this past week we saw prices coming up around 1% across the curve, and further along, or zooming out, in the 12-week change, we primarily note a 10% rally in Cal 28 prices. Elsewhere in Europe, we're seeing a similar trend. probably highlighting Poland, which of course is a lot more coal dependent, having a more bullish rally than the rest of Europe. The Nordics, on the other hand, have been having a stable evolution after a rally which lasted a couple of months throughout summer. Total grid demand continues to be quite subdued, although these past few weeks we've seen an uptick with levels now reaching the average that we've seen since 2019. On the other hand, we have an uptick in residual load, which is now consistently being above 2024 levels, at least for the last few weeks. The European power mix, we can see how wind generation has been underperforming throughout 2025, which has been offset by a good nuclear generation as well as increased solar. Now that we're going out of the summer period, we are expecting solar generation to continue to decline as we see all other fuels picking up what's being left out by wind and solar. As we saw before, nuclear generation has been quite good, even seeing steep spike over this past couple of weeks, particularly in the French nuclear generation, reaching new all-time highs for this time of year. As said before, renewable generation has been subdued somewhat over the last few weeks and is now drifting towards the average that we've seen since 2019. As you would expect, fossil generation is picking up, offsetting the lower renewables. Zooming in, we see that the wind generation has been particularly underperforming, as it has been the case throughout the year, and we see solar generation consistently above previous year's levels. The uptick in fossil gas generation, as we saw, is due to lower renewables in the short term, and also we're seeing fossil hard coal generation picking up given lower and lower prices. Finally, looking at GEOs, we have seen a bearish sentiment to continue after a bullish rally that we saw at the end of July and the beginning of August. And now that liquidity has come back to normal and the market is expected to have less and less demand, we are seeing bearish evolution across the board. Thank you. This is all for us, and we'll see you next time.